So we're going to get started. I know some people are still outside, but we're on a schedule. So I'm here to introduce our next panel, which is Tokenizing Capital Markets. They're going to go through their bio. So in order to repeat, I'll let you get started.
Thank you. And thank you guys all for being here. It's super excited. I'm really looking forward to this panel. I'm Annelise Osborne. I'm head of institutions at Arca Labs. And I'm going to let everyone introduce themselves, but really just kind of stepping back for a minute. We did a study that we released earlier this year and Coalition Greenwich, and we found respondents 77% believed that assets would be digital in the next 5 to 10 years. And so what we need for that to happen is institutions and institutional adoption. So we have this fantastic panel of real key players here, and I'm going to let them go ahead and introduce themselves and tell us a little about what you're doing. Do you want to start?
Awesome. Thanks so much, Annelise, and thanks to Arca for having us. Really grateful and delighted to be here. My name is Morgan McKenney. I'm the Chief Operating Officer of Provenance Blockchain Foundation. I'll share more, but it's a public blockchain built for institutional regulated financial services, the new factory of finance. I'm ex-Citi, recovering banker, if you will, 18 years around the globe in various senior roles, including a decade abroad in Asia and Europe, Middle East, Africa. So keep it short, I'll pass it over.
Hi, everybody. Thanks, Annelise and Arca, for inviting me. My name is Emmanuel Aidoo. I am the head of digital asset banking at Perella Weinberg. Joined there just this year, early January, from Credit Suisse, where I spent, almost 25 years, various roles, leverage finance, technology, ran that both in Europe and then globally for 11 of those years. 5 years running debt capital markets IT. And but the last 7 years are most important for this conversation, which is I founded Credit Suisse's digital asset team, first in the technology department, then moved to equities, where I then worked for the global head of equities, was in the equities exco, and was founded the Credit Suisse digital asset markets business.
Hi, everyone. I'm Hannah Baker. I am a member of KKR's tech growth team. I joined KKR 5 years ago after being an investment banker, and I've had the pleasure of doing a couple of different things, but most recently I've spent the last year thinking about how KKR as a firm engages with and invests in crypto. Looking forward to the conversation.
Great, thank you. Hi, I'm Sandy Kaul. I just joined Franklin Templeton. For the past 12 years before that, I was at Citi. And I created a thought leadership practice where we write about the future of the industry and how it's evolving. And I actually published my first paper about the crypto space back in 2017. And you can imagine I got laughed out of a lot of executive team boardrooms coming out with the hypothesis that tokens could start to replace equities and bonds over time. So it's exciting to be here today and to see the world moving on. And I joined Franklin to stop writing only about the space and start actually building the ecosystem of the future.
Great, thanks everyone. So to set the stage, Manny, will you tell us a bit about the ecosystem of digital assets as you see it?
Yeah, I always think it's important to kind of level set, right? We might have some disagreement, and I think disagreement actually is good because it's healthy, because everyone else then gets a different perspective. But the way I try to kind of explain it to to myself, first and foremost, is this. So most people would used to challenge me at Credit Suisse and be like, hey, what is this big deal about digital? I mean, we're talking not just about crypto, we're talking about tokenization, as you mentioned, right? What is it? And and they would be under the firm belief that we are already digital. And for most people who've been in this industry for, let's call it 20 years, it feels digital. And my argument is actually we're not digital, we're electronic. And so what's really easy to get some understanding, I kind of do it in the past, present, and the future, and I'll be super quick so we can get plenty of discourse on this conversation. It's easy to think about when it was pre-digital, pre-electronic. Let's go to the 80s or let's go 70s. We know what paper certificates are. People around some people in this room probably remember punching tickets and writing blotters, etc. When we describe gold or commodities, we know what that means to be physical versus book entry. This environment that we're in today in terms of capital markets is really about 25 years-ish, right? I started in the industry at DLJ was my first proper job, but 94 was when I really kind of got my break at a company called Caspian, which is an offshoot of Bearings. But at the time, this was like, think about what Microsoft are doing. This is the advent of desktop compute coming to this industry. And what we were finding were lots of people like myself were being employed to write specific programs to solve, like, let's say the blotter problem, or to solve the P&L calculation problem, or to solve the risk problem in different departments. These systems weren't connected, and they got connected later. The internet was 2000, let's call it 98 to 2001. So we first started writing programs. We started connecting them 6-7 years later. And then we started connecting them across institutions after that. And then, so what you realize is, when you think about it that way, you're like, oh, okay, that's why we have so many systems that are out of sync with each other, and why we've got different understandings of data across firewalls. And that's why I say we're electronic. And what is a token? What is digitization? Well, digitization is when you have an asset that for itself, in its own logic, represents its behavior, prevents itself from being put in a wallet of somebody that isn't authorized to hold it, does the P&L calculation for all of its actors at the same time without any difference of opinion. And that's what digital means versus being electronic. And so when you think of it that way, and I'll say my last little thing of it is, let's just put to a side that we've got, the way to think about this is 4 different kind of asset classes. I think of payment tokens, which are broken into virtual currency and fiat. You've got asset tokens, which could be securities, commodities, things that you kind of know and breathe and love today. Then there's these things called utility tokens, which we're going to talk about a little bit later. And then we've got NFTs, which you could think about as tokenizing property or royalties or that type of thing. Most of what we're talking about is actually already existing. Right, so except the virtual currency stuff, which is a bit kind of weird for people to kind of put their head around, most of it, we know what company formation looks like. We know what a bond and an equity is. And what we're talking about is having something that behaves ubiquitously for all its actors. I'm going to stop there because I've been talking for a little while. Hopefully that's helpful.
Okay, how do we move traditional finance into a digital format? I think that's really what we're focused on. So Hannah, I would love to know how KKR is approaching the space.
Sure. So we've been taking really a 3-prong approach. Prong number 1 is education. Things in this space change every day. And so it is our mission to have a really deep understanding of this new sector and this new ecosystem. Prong number 2, we call governance, which is we're a traditional asset manager. We have over 200 traditional portfolio companies. How should we be thinking about disruption? And that also goes for ourselves. We're a traditional business. How should we be thinking about disrupting our own business models to grow into the future? And prong number 3 is taking direct investment exposure, which we do primarily out of our tech growth fund today, but also off of our balance sheet for strategic investments. It's in this second category where we've spent some time thinking about tokenization from both an operations perspective, but actually also from a fundraising perspective. So can we use tokens to access new parts of the market? And what I'm talking about is not only retail, which is the next frontier for traditional alts managers, but also a cohort that we have not accessed in the past. And who I'm talking about is the accredited investors of today, the QPs of tomorrow, the millennials who could not write a $5 million check, but may be able to write a $50,000 check. Oh, and by the way, are much more likely to do so if they see liquidity when in 3 years, they may need to buy a house. And can they sell their token? Is there liquidity for something that would otherwise have been a 10 to 12-year lockup? So that's really where we're focused.
You said disruption twice in 2 of yours. So do you look at it as disruption internally as opposed to upgrading?
Yeah, I think sometimes disruption has a bad connotation. I don't see it that way. I sort of see it as, can we control an outcome to the upside? And I also spent a lot of time thinking about the difference between incremental upgrades and qualitative changes. And so if you're already doing something which is online, like a subscription process, is blockchain just sort of an incremental upgrade? Versus if you're analog and then you go straight to a blockchain, now that's a qualitative shift. So I like disruption rather than upgrade, because I think about how can we fundamentally change the way we approach something that actually increases our upside.
Great. Sandy, what about you?
So I think that there is a natural evolution that happens every time the technology in our industry changes. I think that Manny got to a lot of that in his description of how the computer age changed us and led to the digitization, how we've moved into new strategies, even in the recent years using machine learning and AI. And I think that where we're heading with these digital assets is really going to relate a lot to the composability of these assets. So we're used to an equity that prefers certain rights to an individual, and we're used to a bond that has certain covenants and terms associated with it. What we're not used to is an instrument that acts like an equity, but that can have covenants attached to it and utilization rights, and act more like an actual contract. And so I think we're going to be able to really foundationally, number one, improve, but number two, extend the way that assets work in our portfolios and in the world. And I think that will really stimulate a huge change in investor behavior. So I think that this is such an exciting time in the industry, because we're right on the cusp of beginning this new journey and really utilizing this new technology and understanding its potential. So I think that there's just a great opportunity to be had, and that's why I'm here.
Great. And what about Franklin Templeton? How are you internally approaching it?
Yeah, so with Franklin Templeton, Jenny Johnson, who's our CEO, is a big believer in the future. She really thinks multi-generationally, which is very different for the CEO of a big asset management firm. And we've set up a digital asset unit that operates right alongside our equity unit, our fixed income unit. And our digital asset unit has put into place a four-pronged strategy that has to do with understanding the ecosystem, and really being able to take significant strides. We've actually put a money market fund onto the public blockchain, working with the SEC to do this in a way that's not yet approved, because they haven't really set the rules, but that was really involving the regulators in thinking about how to do this. We're building out listed token funds, where we're actually going to be able to go out and offer a whole range of strategies, from equal weighted to capital weighted to other strategies, looking at the most liquid coins. We're looking at also opportunities to do different types of engagement with the ecosystem. And I think that, our goal in where we're heading is to be not just a participant, but one of the firms that's really helping to define the future.
That's great. And from a use cases perspective, I think it's very important recognizing real use cases. And so something that I've always, looked up to is figure and provenance, because I think not only was first provenance created, but real use cases for institutional use have been created. So Morgan, I would love for you to tell us more about provenance and how figure figures in.
Absolutely. And I would argue, after being in finance crazily for 25 years, this is an incredibly unique time for all of us in finance. It's our 1998 moment in finance. Back in the day when we were all much younger, the internet was just coming and we didn't quite know how transformational it would be. That is where we're at in finance. We've gotten far enough along in digital assets, digital money, and blockchain to actually create the new factory of finance. Change how you issue an asset, how you finance an asset, securitize an asset. It's a new factory. It's entirely digital, born on blockchain, and it creates and opens up so many different use cases: real-time settlement, transparency, visibility, true programmable money. And I'm 2 months into this role at Provenance Blockchain Foundation, and I'm a blockchain practitioner at Citi. I successfully implemented 2 disruptive blockchain projects, one OG in 2018 with NASDAQ Private Markets, and one with Alibaba and Ant when I lived in Asia in 2020. And that was dang hard, right? So that working even across 2 organizations, let's say. And the more I looked into Provenance, Provenance is doing real financial services on chain, meaning issue a mortgage on chain, service the mortgage on chain, finance the mortgage on chain, and securitize the mortgage. And what does that do? That creates incredible business value. That means it's over 100 basis points cheaper to do those activities from that mortgage, that real financial asset. And there's been about $8 billion transacted on Provenance across real assets. So mortgages, home equity lines of credit, private market securities. There's 400 companies with cap table using a Provenance for its cap table, using it for primary issuance and using it for secondary trading. And to Hannah's point about it really creates and opens up new investors. So one of the killer use cases of blockchain is private market securities, because blockchain makes previously illiquid assets more liquid. That means you don't have to hold it for 10 years. You have a secondary market. It's more price discoverable. God bless you. It's more transferable. And it's easier to keep a record of who owns it. So, and then the last vertical that Figure put on. So Figure is a fintech, and they built a blockchain because they knew banks couldn't be first in on adoption, right? This is a very different way for executing financial services. And so Figure has de-risked the blockchain, both from the business perspective, proving the value, but also the tech perspective. And there's over 50 organizations that have participated. And there's digital money on chain now. It's called USDF. It's bank minted tokenized deposits, right? As we've all seen the crypto mento, and you have algorithmic stablecoins. Banks should be participating. You know, all of traditional finance, this is like AWS. It's the new cloud, really, to deliver financial services. Just using the next generation of tech, which is fairly disruptive because it's decentralized. You're not doing intermediated trust, which is expensive and delays settlement. This is real-time settlement bilaterally without having to know the counterparty. But it just opens up some really exciting things. And I took the job because it's already operating at scale and has so much room to go. We're early days, but we partner with Franklin Templeton. They run a validator on Provenance. They own Hash, which is the utility token to pay all fees on chain. And so we're just really excited about collaborating with the industry to transform financial services.
That's very exciting. So let's go into opportunity. So for all of you, why don't we start with Sandy at the end, and we'll come down. Two parts, where do you see the opportunity and what personally interests you?
So the two things I'm most excited about in this space are, number one, there's a huge retirement issue facing everyone in the globe, particularly in the Far East, where the retirement systems are very underdeveloped. And the biggest issue for many individual portfolios is that, excuse me, that they're far overexposed to just equities and bonds, right? They do not have the diversification into alternative assets that we see with all institutional portfolios at this point. So to me, what initially got my excitement up about this space is the idea that we can take real physical assets, we can tokenize them, and we can actually embed interesting utilization rights as part of that new instrument. So the easiest way to understand this is, maybe some of you here in this room today had to come over from Brooklyn. You might have needed to take the Brooklyn Bridge. The Brooklyn Bridge remains one of the few bridges in New York that you don't have to pay with your Easy Pass to get over. But New York needs money, right? And let's say that government wants to get in there and actually raise some money to enhance the Brooklyn Bridge. They could tokenize the Brooklyn Bridge, sell tokens, and program the contract as such that if you buy a Brooklyn Bridge token and you're a partial owner of the Brooklyn Bridge, when that Easy Pass hits your data, right, when you drive through the electronic authorization system, they'll see that you're an owner, and they will open up potentially an owner's only lane for you so that you don't have to deal with any rush hour traffic, right? That's a great way to incentivize new types of investment in local communities, right? So I'm excited about the potential to create programmable physical asset exposure. And I'm even more excited about what I think is going to be a foundational change in the capital raising approach of organizations, corporations, and institutions. I think it's interesting that there's two ex-bankers here on the panel, because I think that banking is one of the industries that stands to potentially be completely disrupted. I think that you're going to see a corporation be able to look at its own set of assets and issue its own tokens to give those that participate in that token pool rights to not only have part of the income stream from those assets, but to be part of the community that helps them think about their future development. So I think that, you know, we really are going to be able to use these much more modern instruments to really redefine and optimize the way that investing and investment exposures work.
Great. Hannah, what about you? Opportunities and what you like.
Yeah, I think that's well said. I think what we're seeing is really amazing innovation across the board that is going to fundamentally change how we interact with each other and with institutions and with investments. When I look out there and look at what's investable, you know, the first wave, which still exists today, was L1s and people investing into like ETH to get exposure to the Ethereum ecosystem. And then there was a second wave, which I'll call like the infrastructure layer, which is okay, now crypto is here to stay. We now need businesses that are set up to help support the growth of this ecosystem. So picks and shovels, things like custody, like tax, market data and analytics, security audit, things that will help the ecosystem mature. And then most recently, we've seen a wave of NFTs and use cases for NFTs and NFT rails and gaming and the likes. And I think where I'm really focused and really interested is the second layer is how can I invest behind picks and shovels that allows this ecosystem to continue to flourish. I'm making bets on the category as a whole rather than picking horses in the race. And together we can sort of bring institutional knowledge that will allow it to continue to grow and to prevail. So that's where I'm spending my time.
Great. Emmanuel?
For me, it's really easy, right? I made that choice. I left an organization that I'd been at and I still call home, family for 25 years because I used to joke, and people have heard me say this, I'm sure, that my day job running digital asset at Credit Suisse was like pushing a very, very heavy rock up an incredibly steep hill, and a winning day is when that rock doesn't roll over and kill you. And people always used to laugh, and I used to laugh as well. And then I sat back last summer and I'm like, hold on, what am I actually meaning here? What I'm actually saying is that a winning day is when my colleagues don't kill me for trying to do the right thing, for actually trying to make the bank and the industry more efficient. How sad is that? Why are my colleagues and peers across the industry so adverse to this change? And it turns out it's really in defense of public market infrastructure, right? I mean, as an industry, we spend $470 billion a year on compliance technology, the top 20 banks on compliance technology alone in support of public market infrastructure. And so I said to myself, where else could I apply this technology in a way that just wasn't as corrosive as where the antibodies wouldn't kick in and wouldn't feel like a heavy rock was rolling over me? And I basically thought private markets. And I think that was Sandy's point, right? So digitization of private markets is my prediction. And I believe this with such conviction that I left an organization after 25 years to go somewhere else, because I believe that we will see in the next 5 years the digitization of private markets established in a way that shows that it's more efficient than public markets. It won't have a clearinghouse. It won't have custody in the same way we think about it today. And public market companies, we already have, I don't know, I think it's 493 unicorns in the United States. And they will have even less reason to want to go public when that asset class is digitized in a way that's liquid, that gives them access to capital, and don't have to be burdened with all the additional oversight and regs. And that's kind of the bet I'm making, and that's what I'm super excited about. And being part of that, you said it, Morgan, it's an exciting time to be in this business, because it really is that we're at that pivotal moment of change. And any one of us who are still in that public market space, good luck and God bless you. But I think the real fun is going to be either in, where the NFTs, private markets, or even in virtual currency land for the next 5 years.
Morgan, what about you?
Manny and I, we talked a bit before this, but we couldn't have I couldn't have said it better. I think, meaning private assets are a killer use case for blockchain, and they're only going to prove the model so that you don't need public markets anymore. Ultimately, what we are trying to do at Provenance is disrupt intermediation. There's a ton of intermediation in massive verticals of finance. Lending is one of them. Interchange is the other, right? Just think there's, the issuer, issuing processor, the merchant processor, and Visa, MasterCard. You have 5-party system there to move that payment instantly. That is expensive. And there's a new game in town. There's a new rail that's cheaper and is more open, right? That everybody can participate in. So on the private side, I talked about private equity securities and private market securities. You won't have to go to the public markets in the future. You will continue to issue on chain, just as you did as an earlier stage private company, and there'll be secondary trading, again, on decentralized exchanges. Ultimately, where you fast forward this, DTCC and NYSE, NASDAQ, et cetera, because one of the most exciting things is, and I'm a person that says digital done right delights, analog does not scale. Private market securities, all these private assets are on paper. They're in a lawyer's cupboard. They're not transferable. There is a better way, a digital one. You can issue more assets, so you can put more on the shelf, which is interesting, right? But then you can create distribution in ways that the users are empowered. I own my asset, you have digital money, we can bilaterally exchange. We don't have to know each other. You just make sure you have the money, I have the asset, and the code confirms that. So you go from intermediated trust, which is very expensive now that we have these alternatives, to truth. Truth is single ledger. Truth is consensus to validate the transaction. Truth is the transparency of everything that ever happened before. And that is just going to create much more efficiency in a broad set of asset categories. That opens up exciting new opportunities, attract new investors, give empowerment to the consumer. I mean, how many of you guys have checked out at Rite Aid, on the self-checkout? Like people, it's empowering when you can actually just handle it yourself in a very easy, high UI, UX way. And financial assets you're just going to feel very empowered by owning your own assets, controlling your assets. You'll still need banks. You might want to have banks keep your keys. You'll still want some intermediation for advice, for insights, for bringing curation. There's a lot of ways to still add value, but that intermediation is very expensive, both in capital, time, and process.
I didn't say what I was excited about. What I was excited about, I think, is we've got the 33 Act, the 34 Act. I'm waiting for like the 24 Digital Act, right? Which basically clears the rails and we can actually all do this stuff and be all happy.
So there's so many wonderful things that blockchain can do with efficiencies and innovation, right? So I know I've had a conversation with Emmanuel and Sandy back in 2018, 2019, and we felt the same way with the same passion, and yet it's 2022 and we're not as far along. And I think, Provenance and Figure have done a great institutional case, but there's not enough of them to talk about. So what's holding us up? What are the barriers to adoption, both from an institutional perspective and kind of even pre-institution? What do you think? Do you want to start? I'll start with you, Morgan, and go down.
Sure. I think one of the things is today, and I also thought before I worked at Provenance, like you couldn't pick a winner because we're still early days and we're still maturing in each layer of the cake: digital assets, digital money, digital identity, digital security, and networks and chains. But I think the hard thing is this is not a plug and play tech yet, right? And it's not the vitamin. It's not you take it and your hair is maybe a tiny bit shinier, right? Blockchain is the morphine shot. It makes the pain go away. But that thing, to get access to that, it's hard work because it takes business process reengineering, right? So if you're a fund, you're issuing a digital feeder, you have to think about how do you integrate that subscription process within the blockchain for the asset issuance, et cetera. So it's not plug and play yet. So it's hard to adopt. You have to change and think about. And by the way, it's this new factory. You have to kick the tires. It works quite differently than how things work today. So there's a whole bit of understanding the new risks that are created, how things are mitigated. So I think the biggest challenge right now is it won't be plug and play. It won't be cloud for a while, where it is easier to adopt and you are comfortable with all the risk, et cetera. So business process reengineering and understanding kind of the new way the asset gets managed over time on blockchain and then reg policy, I think, is sort of the elephant in the room. There needs to be more reg clarity on how to treat digital assets, both from a tax perspective, from a who's regulating it kind of perspective. So those are maybe the big pieces, building blocks that are still open.
I'm just going to be an echo, but I'll try and be slightly wittier, I think, in my response.
Thank you. No offense taken.
Well, unwitty, it's just, maybe it'll just drill home the point. I think the biggest problem is that our senior leaders let's start with industry, because there's industry and there's policy. Senior leaders, and I realized this when I was, I looked at something called the business capability model, which is basically how every institution kind of works, whether you use system A or system B, you're going to have to tick these boxes, and it's like 700 steps. And what I realize is that most people really know their 7 to 12 steps really well. So it's really about this process engineering. And the senior leaders in our institutions got senior because they were the best person at selling the widget, person selling the car, or restructuring or something like that. That's how they got to be really senior. They have no idea how the actual factory works and what all the different steps are. And this isn't to malign anybody in particular, because most people in every organization, if you've worked in 2 departments, then you go, guess what? You know 14 steps. You still don't know 700 steps. And so in order to be really good, you have to kind of do a whole process re-engineering across the entire platform. And then you'll realize that when this is all said and done, what blockchain does is it shrinks the distance between issuers and investors and leaves you with 200 steps. It eliminates a bunch of work, both within your organization and everyone else's organization, as well as intermediaries. That's what it does. And then you end up with this new factory. And then you can go and find the best guys who want to go sell that stuff. And so then the other piece of it, and I said it earlier on, and Morgan re-emphasized about policy, is that we have to recognize that 95% of what we're talking about has already been invented. We're not reinventing capital reformation and equities and preferreds and bonds. We're just representing them in a digital format. So policymakers need to kind of wake up and say, okay, not all things with the word crypto in front of this thing are bad, or all of them are the same. I think it was Ben Bernanke said like 2 days ago, he said, cryptocurrency basically, gold has a purpose. Really, gold is basically in a vault. 8% of gold is actually being used for jewelry, so it's not really that big a purpose. But nonetheless, he said, well, in cryptocurrency's purpose is ransomware. Now, if you've got people like that making statements that are just patently wrong, that's part of the problem. And you've got to acknowledge that 95% of what we're talking about is capital formation, it's tokenized commodities, it's tokenized fiat. We understand these things. Let's just put all of that into one box and say, go ahead. There's certainty, there's rules around it, there's an SRO that manages that, there's an SRO, and then we'll worry about the exceptions, the stuff that doesn't really fall into those boxes and is a bit kind of esoteric. Hopefully that was funny.
Yeah, I think in 2 words, it's human behavior. And I worry a little bit, or I'm cautious, I should say, about sort of the ethos, like the blockchain, not crypto ethos, because I think that's a little bit of a solution looking for a problem. And I think, sure, there's a lot of value locked up here if you get the network effect. So if we were to put all of the mortgages in America on chain, that's a huge amount of value to unlock for sure. But the reality is, at least for the individual, for the retail consumer in the US, we have a pretty good financial system. Like, we all have credit cards, we can all access banking. It's not that painful. And so where I look to is this concept of access. Is like, what can blockchain do for folks who, for whatever reason, for their gender or their race or their access to a stable government or stable banking, what can it do for them? Because that's going to change their lives. And maybe less, like, a second layer to that is, as we watch these next generations grow up and become our investors of tomorrow, like, am I someone who's going to walk into an FA's office at a bank and sit across a desk from a financial advisor? Probably not. And so when we start to lose investors of tomorrow, we're going to figure out new ways to access them. But it's all dependent on human behavior and human reaction. And that's why I brought up earlier, like, I'm very cautious about blockchain as incrementalism versus blockchain as, like, qualitative change.
Yeah, and I think that, look, it's very different, right? I remember when we first started talking about cloud architectures with people in the financial industry, the number one thing you heard over and over is we could never do anything in the cloud because it's all open source programming, right? and it's open, and we're all proprietary shops, and we have huge value in our proprietary systems that we've built, even though I've got 17,000 of them that costs me a fortune just to keep going. They're so valuable, that proprietary system. And now you don't hear that anymore. People don't say, oh, open source code is bad. People are like, oh, I'm integrating open source code into my system, and I'm getting this data, and I'm working these processes, and I'm orchestrating these different points of communication in my organization. And so this technology is new. This technology is different. This technology has a different ethos behind it. But it's an ethos that we should all recognize, right? We're all consumers in the world, right? We all go out and we buy things online. We're used to things being tailored to us, and we see this whole industry that's evolved around people quantifying our behavior and using that understanding of our behavior to drive products and services to us, right? This is where the world is headed. But we have to understand that in that economy, the greatest resource there is people's attention and people's participation. And what this new digital ecosystem is going to do is it's going to allow us to actually financially incentivize participation, right? And that is going to be, as we used to say about email, the killer app. Right? Once I understand that transacting in this new ecosystem actually not only gets me more efficiency and all the great benefits that everyone's been talking about, but my participation in the system itself actually earns me extra money, and it actually gives me more opportunities to weigh in on how I think the system should work. That is where I think that people are underestimating just how transformational this is all going to be. So I think that there is, I like how you're putting it, Helen, in terms of, I think that the efficiency and the improvements and the better operations of the systems, those are almost the incremental changes when you think about how transformational this can be. And really understanding that finance follows behavior, and behavior is changing, and finance needs to change with it. I think that's going to be by far the more profound realization. And it's just going to take us a little while to get there. I mean, we went from saying I could never use open source with my proprietary systems to everyone rebuilding everything in 10 years. This one will probably take us 5.
So if I'm a big bank and I'm selling securities, and you've typically bought securities from me before, but I want to sell them in a digital block of $50 million, right? So would you accept them? They're a typical credit deal that you would accept before, and from what I'm finding is people generally don't want to accept those as tokens or in digital format. Morgan, you, instead of putting anyone on the spot, you actually sell loans, and you actually sell them in digital form. So how did that conversation go, and how did you make that happen? Because that's where I think we need the ecosystem. We can tokenize, but we need to have institutions purchasing them as well.
Absolutely. And so I think the neat thing, and one of the smart things Figure did, was it focused on mortgages. Because why mortgages? There's actually a digital controllable asset that exists that's protected in law today. It's called an e-note. In e-note, if you control the e-note, you control the asset, and that's embedded in law in the Uniform Commercial Code. And basically, there's a couple other assets that look like that, like auto loans, again, protected. The E version is protected from a legal perspective. The good news and we believe that you shouldn't have a digital twin, right? There shouldn't be a physical thing over there and then you represent it on chain. That creates a whole bunch of problems. The thing needs to be born on chain and protected from a legal perspective, that if you own it on chain, you actually own it, right? From a legal, if it went to court, et cetera. The good news is, and I'm not a lawyer, but our very talented lawyers, and you and I had a big chat about this, as we think about the tokenization of assets, when can the rest come on, right? Securities is also there, so securities are protected in law. And Figure has what's called an ATS exemption to trade blockchain securities in a secondary market, so that creates the secondary liquidity. But other assets are coming on through this. It's called UCC Article 12, which will hopefully be passed this summer, July 2022. That focuses on a range of emerging tech, other digital assets. So like e-HELOC, and then it goes across the states. So most states will incorporate UCC Article 12 within a year, and then maybe laggards in 2 years. But what it means is you can issue natively on chain a broader categorization of assets natively and have them be legally protected, and that you control the asset if you control it on chain. So that's an exciting underarching or overarching, if you will, legal framework that I think will help the financial industry be able to adopt more digital assets and be more comfortable buying them on chain and owning them on chain.
I'm being notion that we have. Does anyone have questions? If you have questions, let's raise your hand and we'll have someone come to you with a microphone. Sorry for the abrupt. I realized we're getting short on time. But I think I think it's all amazing and there's so much we can do. We just need to get there. So how do we pave the road to get there? Sorry, go ahead.
Yeah, Morgan, thanks for the comment on UCC 12. Does that change if a protocol wants to originate an unsecured consumer loan? Do you foresee with UCC 12, they still need a bank involved, like a web bank or a Celtic bank, like they did in FinTech 2.0? Or will the smart contract actually be deemed like the originator on record?
Yeah, I mean, I think there's still licensing involved, right? Like, so Figure has the license to sell mortgages, right? So again, I'm not deep in on certain types of assets. I came more from the trading side and transactional banking. But I think for certain activities to issue certain types of assets, you will still have to have that licensing. However, the point is, if it's natively issued on chain, you control the asset from a legal point of view and ownership point of view. So I can't maybe LinkedIn me and I can direct you to folks that can find out. So you need licensing, obviously. So Figure Pay, which is a bank on a blockchain, has to have money transmitter licenses, right? To move the digital money, whether it's across a business or a person, et cetera. So they have licenses in 48 states now, so you'll still need licensing to perform certain activities. Same thing like Figure's broker ATS exemption to trade in secondary markets. So yeah, I don't know if I understood your question. Banking for the financing or what component? Maybe a follow-up question, or come see me after.
It's actually asking about the underlying smart contracts. There is zero chance that you're going to be able to have a smart contract autonomously not licensed under UCC 12. Zero chance. You will have to have a license, and then there's got to be some way for the regulator to call and say, well, who owns this and who's at fault?
Thank you.
Any other questions?
For the capital market to be tokenized, I think the biggest hurdle is the transaction fee. Like the Board Ape real estate, the transaction fee went to like 20,000 for one transaction, and the proof of work or proof of stake both have issues. And until that problem is solved, I don't see this becoming mainstream. What's your view on that?
Wait, which one isn't becoming mainstream? Sorry.
I think the proof of work and proof of stake are the two potential candidates, right?
Yeah.
But both of them have issues.
Okay, well, it's a great question. I think Provenance is a proof of stake built on using a Cosmos SDK and Tendermint consensus. And it was built specifically for financial services, meaning high throughput. Proof of stake gives you higher throughput. It's less intensive to confirm the transaction. It also allows for data control. So PII is not on chain. I think we can speak about it later, but different chains are designed to optimize different things. So Provenance is designed to have gas fees very low. And that's to prevent zero cost attacks on the network. So you have to own hash, the utility token, to start trying to take over the nodes. And then there's smart contract fees that allow developers to monetize what they're building to create value on the chain for participants. So in proof of work, the Ethereum cost price is a supply and demand equation. There's a ton of people that want to use it and only so much computing power to be able to process the transactions in the proof of work status. So it really does depend on the chain, is sort of how I would answer the question of how the fee volatility changes based on the design of the network. Yes, I think proof of stake solves it. So, and we can get into why later.
Any other questions? We got a few seconds left. We got one back here, or a couple. Actually, we have a couple. I feel like we got out of what's happening the next 12 to 18 months. That was the next question. Where you see us next year?
How do you think beyond tokenizing capital markets, tokenizing other sort of related things like insurance, maybe the deeds to the home? Those are key parts of that process. Where do you see it expanding perhaps beyond this for capital markets?
I actually say hate the word. I don't like the word tokenization because it creates this. I mean, it creates for me anyway this image of let's think of something even worse, probably like poker or something like that, where you got a token, you got a chip that represents something else. And in actual fact, assets represent like rights, obligations, and benefits. And the way I kind of describe it to my kids is like, you got a house, right? And your house, you have the right to live in it, the benefit of home price appreciation, and the obligation to mow the lawn. And so it has all three things at the same time. If I decide to rent my house out, right, I no longer have the right to live in it. I've given you a time-bound right to live in it, but you don't have the obligation to mow the lawn, nor do you get the benefit of capital appreciation. And so when you think about digitization in that way, and you ask your question again about insurance or other things, what you're really saying is, how can I take a smart contract? How can I take a computer program and actualize behavior in a way that's contiguous and consistent across a network? And that's not actually that hard. So tokenizing is like, it makes, and you can achieve it with tokens, but you'll end up with a token that represents rent, a token that represents capital appreciation, a token that represents mowing the lawn. I could sell the right to mow the lawn to the local loan guy, and that's worth $40 a week for a year. And he can actually go and take that and use it as collateral if he wants to. This is just the financial engineering that we've been doing, but we've latched onto this word token. It's born from actually the idea of Bitcoin being able to be used for something else, but it's completely the wrong term, right? And we should be focusing on smart securities and smart contracts, and that's closer to what we know how to do, what we've been doing for the last 25 years in this industry.
Maybe to pile on, I think it's going to be tough retroactively to convert certain analog methods to something on chain, like for example, deeds. I think you can certainly think about doing so on a go-forward basis, but the way I look at it is the more that we have folks interacting natively on blockchains and with tokens, then there will be native solutions. So I think rather than, at least the way I see it, rather than focusing on a tokenized version of sort of analog insurance, there will be insurance available via token that is crypto native.
Great. Well, thank you all so much. I've really enjoyed this. I appreciate your time, and thank you guys all for listening. And we have another panel coming up.
Thank you.